Good evening, ladies and gentlemen, and a warm welcome to SARS's webinar on trust compliance. I am Anae Hendricks, serving SARS as segment leader for tax-exempt institutions. It is an honor to facilitate the webinar this evening, and I trust that you will find value in our session and gain clarity and insight on how to meet your tax obligations for trusts. We look forward to engaging you this evening as we explore relevant compliance information and discuss a wide variety of topics within the trust tax environment. I can see that there is keen interest as we already have quite a lot of participants joining us this evening. Before we continue with our session, I'd like to make you aware of the following. Upon concluding the webinar, you'll be requested to fill out a brief survey. We encourage you to please participate in this survey to the fullest extent, as your feedback is greatly valued and will be used to shape and inform future engagements. Please also feel free to post all your questions in the Q&A bot. Due to the POPI Act and tax secrecy provisions, please do not post any personal information when asking questions. If you are attending this session via YouTube, you will not be able to ask questions. Only those who have registered for this webinar on the Zoom platform will be able to post questions. We will try to answer as many questions as possible, either through the Q&A chatbot or with the Q&A panelists later during the webinar. And if we don't get to all of your questions, some of those questions will be posted on this website under the FAQs after this webinar. Please, if you happen to experience any interruption, don't worry, the recording will be available on our YouTube channel for future viewing, and the presentation will also be uploaded on the SARS website at the end of the webinar. And I've already noted that we have a question asking whether the slides will be available. So yes, it will be available after the webinar on the SARS website. Our program this evening is divided into two parts. The first session is the presentation from our specialists, which will be followed by a Q&A session hosted by a panel of experts from the questions posted on the Q&A bot. So ladies and gentlemen, without further ado, and to kickstart the much-awaited program of today, help me welcome our keynote speaker, Advocate Sam Murrigan. Advocate Sam is the product owner for trusts at SARS, and she leads the trust product unit within the strategy enabling and modernization cluster, where she drives strategic analysis and the design of future trust tax products. Her extensive executive and legal career is backed by the following qualifications: a BA, an LLB, an LLM, and an MBL, as well as a management diploma from Henley Business School. Over to you, Sam.
Thank you for that introduction, Program Director, and for the opportunity to deliver this keynote address. To all participants, I want to thank you for joining us today as we delve into critical aspects of compliance for trusts. Our goal is to ensure that all stakeholders are well informed and equipped to meet their legal obligations efficiently. SARS has noticed that many trusts have not complied with critical tax requirements, leading to concerning levels of non-compliance for registration, filing, declaration, and payment. It is our intention to bridge that gap and ensure that everyone understands and fulfills their tax obligations correctly. SARS is in the process of implementing its modernization program for trusts, replacing all manual processes. The program includes announcements for registration, filing, declaration, and payment processes. Stakeholders would have observed, amongst others, the implementation of the SARS online query system, what we commonly call SOX, the verification and dispute processes, and the rollout of the IT3T reporting processes. SARS will continue to prioritize and implement these modernization efforts. As part of the trust campaign linked to filing season for trusts, SARS aims to assist trustees and their representatives by conducting regular workshops, stakeholder engagements, webinars, and training sessions to provide updates on the latest tax laws and compliance requirements. We have established a monitoring system to track compliance levels and provide support to trustees and trust representatives who may be struggling with adherence. We want to maintain open line of communication for these stakeholders to ensure that any changes in tax legislation and compliance concerns are promptly communicated. The 5 key focus areas by the speakers today are the following. We want to focus on registration of trusts. All trusts must be registered with SARS. There's no exception. Registration should be completed upon receipt of the letters of authority from the Master of the High Court. My colleagues, Nosipo Kumalo and Nozuku Msita, will provide us additional detail on this. We will then move on to timely filing of accurate trust returns. Trustees and trust representatives must ensure that all registered trusts file accurate tax returns, be it the IT12T, and we now have the IT3T, and there's always been the IP6 where applicable. They must do so on time. Delays or inaccuracies can lead to punitive action from SARS, which can be costly for trust taxpayers. Michael Kraski will lead the conversation on filing compliance, and Yang Kutsie on the need to submit accurate returns. We will then focus a little bit on timely payment of taxes. It is crucial that all tax payments are made on time to avoid penalties and interest charges. Tax practitioners should guide their clients to ensure timely compliance. Nontlantla Kumalo will address aspects of payment compliance. We then move on to a topical subject, the beneficial ownership data submission. Obtaining and submitting beneficial ownership data is essential for compliance with the Financial Action Task Force requirements, the FATF requirements. This data helps combat financial crimes, promotes transparency, and enhances tax collection. Michael and Nozuku will elaborate further on this. We then want to talk a little bit on trust to non-resident trust distributions. When distributing funds from a SA trust to a non-resident trust, there are several important considerations, including the tax rate, capital gains treatment and rates, approval processes, exchange control, the trust instrument compliance, tax clearance. Jan will take us through these requirements. The various speakers will guide you through the requirements related to the 5 focus areas to ensure that you stay informed and compliant. Let's work together to ensure a transparent and efficient tax system for all. Thank you for listening to me. I hand you back to the program director.
Thank you so much, Sam, for the very warm welcome address and sharing what can be expected this evening. Colleagues, my apologies. I believe that you were able to hear me, but not necessarily see me. You weren't missing too much. And I do hope that everything is back on track now. So if I may recap what we can expect this evening, this educational session will shed light on how best to comply with your trust obligations. And it covers the most topical issues relating to trusts and all those pressing matters such as beneficial ownership, submission of third-party data, and so much more. Please remember to post your questions on the live Q&A bot. And if you have joined us a little bit late, don't worry, the full recording can be found on the SARS YouTube channel. Next on our program will be the team of experts that will be sharing their insights. I'm going to hand over to our first presenter, Nosipo Kumalo, who will provide us with a general overview of trusts, providing an explanation of the different types of trusts. She will be followed by other experts who will provide both practical as well as legislative imperatives across the trust value chain. And over to you, Nozipo.
Thank you very much, Program Director. Good evening, ladies and gentlemen. My name is Nosipo Kumalo. My role in this presentation is to highlight the general overview on trusts, then later discuss the channels for submitting outstanding documents during registration and maintaining registered details. Let us start by defining what a trust is. A trust is a legal arrangement where one party, which is the trustee, holds and manages the assets for the benefit of another party, which are the beneficiaries. There are different types of trusts, each serving unique purposes. There is an inter vivos trust, which is a trust that is created during the lifetime of the founder through an agreement between the founder and the trustees. Then there's a testamentary trust or the motus causa trust, which is a trust that is set up in terms of a will and comes into effect after the founder's death. Both the inter vivos and the testamentary trust are registered with the Master of the High Court. And then under the Trust Property Control Act, there are two types of trusts. There is an ownership trust, which is a trust under which the founder or settler transfers ownership of assets or property to trustees to be held for the benefit of defined or determinable beneficiaries of the trust. Then there is a Bevent trust, which is a trust under which the founder or settler transfers the ownership of assets or property to beneficiaries of the trust, but the control over the property is given to the trustees. In both mentioned cases, the trust can either be an inter vivos trust or a testamentary trust. Additionally, the terms and conditions of the trust instrument will dictate which of the two categories will be applicable. Then trusts can also be described by the rights they confer on beneficiaries. There is a vesting trust, which is a trust where the income, capital gains, or assets are vested to a beneficiary in terms of the trust instrument. Then there is a discretionary trust. A discretionary trust is a trust where the trustees have the right to vest income, capital gains, assets, or retained amounts in that trust to its beneficiaries. The third one there would be the hybrid trust. So a hybrid trust is basically a combination of the vesting trust and the discretionary trust. Then there are also special trusts which are created in terms of the Income Tax Act. Special trusts are designed to serve specific purposes, often related to the care and financial management of individuals who cannot manage their own affairs. There are two types of special trusts. There is a special trust type A, which is a trust that is created solely for the benefit of one or more persons with a disability as defined in Section 6B1 of the Income Tax Act. A special trust can either be an inter vivos trust or a testamentary trust. So a trust that is created by court order as a result of road accident fund claims is an example of a special trust type A, provided that it is created for the benefit of one or more persons with a disability. Then the second special trust type is the special trust type B, which is a trust created by or under a will of a deceased person for the benefit of beneficiaries who are relatives in relations to the deceased person, whereby the youngest beneficiary is a minor. So in this case, a special trust type B can only be a testamentary trust. I would also like to just highlight that special trusts are taxed on a sliding scale, similar to that of a natural person's, rather than at a flat rate of 45%. However, they do not qualify for any rebates provided for in Section 6 of the Income Tax Act. Then there are also collective investment schemes and securities, which are often referred to as mutual funds or unit trusts. So this is a type of investment vehicle that pools money from multiple investors to invest in a diversified portfolio of securities such as stocks, bonds, and other financial instruments. What is important to note here, ladies and gentlemen, is that collective investment schemes and securities are registered as trusts for income tax purposes, whereas collective investment schemes in property are registered as companies for income tax purposes. There are also non-resident or foreign trusts, which are trusts that are established in a foreign country and therefore not registered with the Master of the High Court. Lastly, I would just like to highlight certain philanthropic trusts that may qualify as tax-exempt institutions. It is important to note that only inter vivos and testamentary trusts are considered for exemption from income tax. So depending on the objectives and the activities conducted, applications may be made with SARS for classification as a public benefit organization or a small business funding entity, the SBFE. It is important to note again as well that if you are approved as an exempt institutions trust, you will submit a different type of return, namely the IT12EI, and the tax rate applicable here is 27%. For more information on this, please visit the SARS website on www.sars.gov.za. I would now like to hand over to my colleague Nozuko, who will take you through the legal requirements to register a trust. Over to you, Nozuko.
Thank you so much, Nosipho, on that explanation on trust types. A very good evening to everyone on this call. As you might know, trusts are widely used for many purposes, and it is no longer an instrument that is used by the rich only. But as many people have become aware of the importance of a will, assets are bequeathed to dependents and non-profit organizations using this instrument. As widely used as it is, one would think that people know the requirements relating to a trust. However, the converse is true. There are tax practitioners and professionals who don't know that a trust needs to register for tax. Our analysis also has showed that a trust takes on average 2.5 years or more after registering with the Master of the High Court before they come and register at SARS. Now, in answering the question whether there is a legal requirement to register for tax, the answer will be the obligation to register stems from the requirement to file a tax return. Now, this requirement can be found in the public notice that is published by the Commissioner of SARS on an annual basis, prescribing who must submit a return. Michael is going to give explanation on the requirement to file under the filing section. The Tax Administration Act in Section 22, read together with Section 25, provides that a person obliged to register with SARS should do so within 21 days of so becoming obliged. Now, of importance to note is that there is no stipulated threshold for the submission of a trust tax return. So whether a trust is operating or not, or whether it is dormant, it is required to submit a tax return, and therefore it is required to register for tax. Jan is going to give us an explanation of SARS stance when it comes to this term, dormant trust. Now, by way of an example, using a vesting trust or a bevind trust, a vesting trust by its nature, it distributes or vests all the income and capital gains or losses. However, even though all the income and capital gains and losses are vested, it must file a return, and it is therefore required to register for tax. For non-resident trusts, the requirement to file a return is also in the public notice, and the public notice states that any tax that is not a resident in the year of assessment that has carried on a trade through a permanent establishment in the Republic, derived income from a source in the Republic, or derived capital gains or loss from disposal of an asset must file a return. Now we know that to file a return, you must first register. Coming to the information that is required on registration and the channels available to register. The documentation that is required on registration includes, among others, letters of authority that is issued by the Master of the High Court, a copy of the trust deed for an inter vivos trust or a will, for a testamentary or a mortis causa trust. Also, identification documents and contact details of trustees, beneficiaries, and tax practitioner where applicable. A detailed list of this documentation, it is available from the trust webpage via SARS website. Also required at registration is beneficial ownership details of the founder, the donor, trustees, beneficiaries, and any other person who may have effective control over a trust. Now coming to registration of a trust. To register a trust, you may do so by visiting the SARS online query system via the SARS website. And for any assistance with regards to registration, you may do so via the SARS website by booking an appointment. Who is the representative taxpayer of a trust? Now, this is an area of confusion. This we have noted that this is an area of confusion for some taxpayers. Hence, we decided to come and clarify this on this platform. Section 153 of the Tax Administration Act defines a representative taxpayer as a person responsible for paying the tax liability of another person as an agent, excluding a withholding agent. A representative taxpayer, it can be a representative taxpayer in terms of the Income Tax Act, in terms of the 4th Schedule of the Income Tax Act, or in terms of Section 46 of the VAT Act. Now, for a trust, a representative taxpayer is a trustee, or what we call the main trustee. This is not a legal term, the main trustee, but it is an internal term that is used at SARS. A representative taxpayer needs to have a valid power of attorney confirming authority to act as such. Coming to the tax practitioners, what are the tax practitioners allowed to do and not to do? But first, we're going to explain or define who a tax practitioner is. A tax practitioner that is accepted or recognized by SARS is a person who is registered with a controlling body and SARS. He or she is assigned a unique identification number. With regards to first-time registration, a tax practitioner is not allowed to represent an entity for initial registration at the entity and product level. However, a tax practitioner with the power of attorney is able to perform additional registration or subscription at the product or entity level after the first-time registration has been processed. So I would like now to mention that we receive a lot of queries or escalation from the taxpayers, and especially after the implementation of the IT3T. To the tax practitioners, I would like to appeal and say, before you send that email with regards to a query, will you please make use of the trust webpage? There's a Q&A section there. We also have external guides and also tutorial videos available on SARS TV. You might find that the query that you are raising is already addressed in those platforms, and you will save yourself some time. Now, in aligning with the strategic objective of making it easy for a taxpayer to comply, we pay attention to the queries that are submitted to us. And where there is a gap in our systems or processes, we endeavor to update our policies and to enhance our systems where possible. So one of the queries that we received relates to a tax practitioner who could not update or correct the trust reference number, and this could only be done by the main trustee. But now, after the update of the policy, a tax practitioner with a power of attorney will be able to correct or update the trust reference number on behalf of the trustees. A second issue relates to the validity period of a proof of address, where SARS closed cases when the 3-month period had lapsed. The challenge here was with regards to consultants who start working after the 21 days turnaround period. And now the proof of address is older than 3 months. So what will happen now? The consideration will only be to the date when the statement is submitted or issued, not the date when the consultant starts working on this case. I also want to give explanation on the process of deregistration. Now, this is a bonus from me to you because we have noticed that there are a lot of people that are inquiring about the process of deregistration. So to deregister a trust, you may do so by making a booking at the SARS branch via via the SARS website. You may also do so by using the Contact Us email channel. The documentation that is required when you deregister is a confirmation letter from the Master of the High Court, confirming the termination date. Also required is the distribution list and the annual financial statements until the date of termination. Thank you. Now I'll hand over to my colleague Nosipo.
Thank you, Nozugo. Nozugo did mention that trusts can be registered via the SARS online query system. So during the trust registration process, a trust may in certain instances be required to submit outstanding supporting documents. So for example, if a trust has submitted an incomplete IT77TR registration form, SARS may issue a letter requesting the completed registration form. So upon request, the documents can be submitted in the following ways. You can either submit via the contact us at sars.gov.za email address. It is recommended to include the trust registration case number that you received after registering on SOX and in the subject line of the email, and to just ensure that the request for outstanding documents letter is attached with your supporting documents. And then another way to submit would be via the SARS online query system. So the requester's details, as well as the trust name and the trust registration number, must be captured. So to capture the trust registration number, you will need to select the drop-down menu on ID type and then select the trust number. Once you have selected the trust number and you have captured it, it will not be mandatory for you to complete the income tax number. Please note that you are required to submit the outstanding supporting documents within 21 business days. Failure to submit within this time frame will result in the decline of the trust registration application. Consequently, you will be required to submit a new trust registration application via the SARS online query system. Should you encounter any issues with the submission of the documents, please contact the SARS Contact Centre for further assistance. Then I would just like to talk about the importance of maintaining your registered details. Please note that according to Section 23 of the Tax Administration Act, taxpayers must inform SARS of any changes to their registered details within 21 business days of the change. The Maintain SARS Registered Details functionality is available on e-filing and can be accessed to view and edit specific information. Additionally, the guide to complete the registration, amendments, and verifications form is available on the SARS website. Note that the trust registration number will be locked and updates to these fields can only be made at a SARS branch. Please do remember to make an appointment before visiting a SARS branch. Thank you very much. I would now like to hand you over to my colleague, Michael Hraski, who will take you through the filing requirements. Thank you. Over to you, Michael.
Thank you, Nosipo. Thanks for putting that so eloquently. Ladies and gentlemen, I get to a subject of critical importance, and that is the filing of returns. Now, Nozuko has indicated how you should register and why you should register. I'm not going to belabor the point too much at this stage. Failed to say that in your notes that you will receive afterwards or this presentation, you will see that in terms of Section 66 of the Income Tax Act and Section 25 of the Tax Administration Act, the public notice is issued on an annual basis by the Commissioner that indicates the requirement to file a return. Now, to make it pretty clear, the requirement to file a tax return for a trust has been there for at least the last 25 years, as the first time that I could pick it up was in the year 2000 in the public notice, where the Commissioner required that trusts submit a tax return. So for those trustees and those representatives that have not yet ensured that their trusts file, please make sure that they do actually file. So bearing in mind that the requirement by the Commissioner is not to file only if you are economically active or if there's activity within the trust, it is a requirement that requires of all trusts to submit a tax return on an annual basis. I would just like to make that very clear. So if you have fallen behind at this stage, please make sure that you catch up in terms of your filing. So of concern to SARS is the percentage of trusts that actually file a return once they have registered. And unlike what is commonly thought is that some of the older trusts are those that do not file, our statistics have proven that even trusts that have registered within the last 5 years do not submit those returns. And there might be consequences for those trusts who do not submit a return, but I'll get to that in a short while. Also of concern is on-time filing. Now, we saw a little bit of a spike during the previous year in terms of a lack of on-time filing, but after engaging with stakeholders in the industry, it became clear that one of the requirements, which was the beneficial ownership requirement, resulted in a lack of timely filing or on-time filing by trustees, but it picked up following the year end, and our total number of filings was at the end of the day similar to the prior year. Now, hopefully this year, with some of those requirements having been met and some of those things already being in the public space, we will now see an increase in filing in terms of those trusts registered versus those that actually file. Now, to assist in this process, the filing dates for trust for this specific year of assessment, being the 2024 year of assessment, has been extended to the 20th of January of 2025. Now, as you are aware, majority of you would be aware, usually the filing date coincides with that of PIT, but due to other important IT requirements within SARS, it was extended to a later period due to the late implementation of the new return for filing. So you have up to the 20th of January 2025, I reiterate that date, to file your return. Now, what is of importance is that this date applies to both provisional and non-provisional taxpayers. And I would just like to stop at the concept of provisional versus non-provisional taxpayers for a minute. What is the difference between these two types of taxpayers within the SARS context in relation to trusts? In the fourth schedule to the Income Tax Act, there are definitions in relation to what is a provisional taxpayer. So to make it easier for taxpayers and for everybody on the call, you are welcome to go to the SARS website and you will find information. There's a guide on provisional tax that you can consult, and there you will get the information on who needs to submit a provisional return, an IRP6, as Sam indicated, and who are not required to submit an IRP6. So it's actually pretty clear from a trust perspective. In the past, it used to be very simple in the fact that if you declared more than R0, in other words, if you declare R1 of income on your income tax return, you will be a provisional taxpayer. That was the previous definition. However, with the change to the legislation in terms of Section 25 Cap B, where non-resident distributions are now taxed in South Africa, the definition has become slightly more complex. This is due to the fact that where there are amounts vested to non-resident beneficiaries, those amounts will now be taxed in the trust. So even if you have a vesting trust, like Nozuki indicated earlier, but there are some of those amounts that are vested to non-resident beneficiaries, then you will be required to submit a provisional tax return because of the fact that you will be paying the tax on that amount that was vested to the non-resident beneficiaries. So be aware of that subtle change that has implication for provisional taxpayers. All right, then how to file. We in essence have two methods of filing. The first one is the one that I would presume that the majority of people on this webinar would make use of, and that is e-filing. So if you're not aware, you have to register for e-filing once your trust has been registered at SARS. And as Nozuki indicated, for your first registration, the so-called main trustee, as she indicated, needs to register the trust at SARS. And then after that, you would be able to do the e-filing registration. Should you not know how to do it, we have a significant number of videos and tutorials and guides that will help you with the e-filing registration. Failing e-filing registration, there might be those that would wish to visit a branch to do their filing. Take note that there are certain requirements in terms of this, and also very important that if you want to file at a branch, you need to make an appointment via the SARS website to ensure that there will be a slot for you. And then you will have to take some documentation with you. I'm not going to delve in that too much at this stage, but you are more than welcome to go to the comprehensive guide on the submission of your tax return, your trust tax return, and there you will find the information that you need to take along when you visit the SARS branch. All right, so let's talk a little bit about the actual filing. So you get to the ITR12T, and you now want to submit your tax return. So we had a webinar earlier in the year specifically focusing on some of the changes. Now, subsequent to those changes or those new initiatives being introduced, we have experienced some problems, and obviously we tried to improve on those issues that we experienced, and I'm just going to delve on a little bit on some of those issues. So in terms of beneficial ownership, one of the main concerns that were given to SARS by its stakeholders was the fact that all of the beneficial owners had to be captured manually. So SARS heard you, and for the second year of assessment where beneficial ownership is now required, being 2024, those beneficial owners will now be pre-populated in your return. So for those that have already done it, would notice that it's already there. If you then wish to make amendments to the beneficial ownership information, then you do so, and then you confirm by ticking a box to say that the beneficial ownership that you are declaring in the return is an actual correct version of the actual beneficial owners. So I'm just going to touch on beneficial ownership again for those that might have missed our previous webinar. In essence, the FATF requirements for beneficial ownership is quite onerous in the sense that you need to indicate information of the warm body or the natural person that's behind the trust. In other words, that person that has effective control or management over the assets or income of a trust. So in that regard, the founder could play a role that would be determined from the perspective of the trust instrument. However, for the requirements of declaring this information in the income tax return, you are required to provide us with the information of the founder, of the trustees, of the beneficiary, and where applicable, the protector. We don't really find that term used in South Africa, and I'm not going to delve on it, but we have seen one or two trusts that actually has a protector in them, so they need to declare that information. It's especially dominant in relation to non-resident trusts. who also need to submit this information, by the way. And then the fourth one is a donor. Now, this is an interesting one and not one that you would be able to ascertain from the letters of authority or the trust instrument. It is where there is a party that donates assets or income to a trust, and as a result of that donation, they retain effective management or control of some nature on a certain portion of the trust capital. So in those cases, you will be required to submit that information. And ladies and gentlemen, while I'm on beneficial ownership, be aware of the fact that the master has introduced a beneficial ownership register. You are required to submit beneficial ownership with the master on the master's portal. Be aware of the fact that this deadline date is tomorrow for last submissions of beneficial ownership. So if you haven't done it yet, get your documents together, go to the master's portal, and also ensure that you comply in relation to that. I just want to warn you that the master has been given significant powers in its latest amendment to the Trust Property Control Act, to the extent where penalties to about 10 million rand may be issued by the master. I don't think we should worry about that too much, but I would rather err on the right side of that 10 million rand fine. So please make sure that you comply. Then another interesting evolvement was the introduction of the passive trust. Now, I'm not going to deal with passive trust too much in my speech now, but I'll leave it up to my colleague Jan, who will tell you, what considerations you should take to decide, are you a passive trust? But for those that are a passive trust, we have made it quite simple for you to comply in terms of submitting your income tax return. When you open your income tax return, there will be a tick box, and you can tick that you are a passive trust if you comply with the requirements. Jan will deal with that, but it's also in the guide. And also be aware of the fact that you need to have been passive for the full year of assessment. If for a portion, maybe only a month or a day, you were active in that trust, you no longer qualify as a passive trust. But should you now be a passive trust and you submit your tax return, then you will tick the box that says passive trust when you open the return, and it will only require of you to submit two pieces of information, being that of loans made by connected persons in relation to the trust, made to the trust. So if you are a beneficiary, for instance, and you've made a loan to the trust, you will be assessed in terms of Section 7 Cap C. If that loan is subject to Section 7C and all of the whole of Section 7C, then you may be assessed based on that, but Jan will also deal with that. Then also beneficial ownership. You will be required to supply beneficial ownership information, even if you are a passive trust. Right, then we get to a very interesting subject, and that is the IT3T, third-party data return. So that is in essence what the IT3T is. It is a third-party data return that is required, once again, by a general notice issued by the commissioner on an annual basis. And this year, the commissioner has added the IT3T to the documents that need to be submitted by the representative taxpayers. And as you may be aware at this stage, as Nazuki indicated, trustees are the representative taxpayers of a trust. So you're required, in terms of that notice, to submit an IT3T. Now we realize that during this year, there were some challenges in submitting the returns, and hence we will not issue penalties for this year of assessment for the non-submission, but we would like to appeal to all tax practitioners and trustees to ensure that even if they submitted late, the date was for submission was 30 September 2024, even if you submitted late, please do submit it. It would have two purposes. The one is, from a SARS perspective, we get the information and we can do our testing and we would test this for purposes of pre-populating returns in future years. And secondly, tax practitioners and trustees will be sure that for next year, when it becomes mandatory for you to submit, then you will already know that you've done one and you now know how to submit the return. If you keep on struggling with this, there are some guides on the SARS website and tutorial videos that may assist you. Then also, if you're not able to submit it by that, please send us an email to the SARS email address, and we will try and see if we can help you with your problem. Okay, then I want to deal with one or two other matters, future developments. So future developments, ladies and gentlemen, I mentioned penalties a little while ago. So going forward, as of the April 2025, SARS will be introducing administrative penalties for the non-submission of tax returns. This means that if you are required to submit a tax return, and as we noted from the previous speakers and from the first part of my presentation, all trusts are required to submit a tax return. If you fail to submit it, admin penalties may be levied on those late submissions. So for late submissions and or for non-submission of filing of your tax returns, we may then penalize you, but we will be publishing a little bit more detail, as we said we would do, to stakeholders in the industry shortly. Please take note of all of the channels, and we will be communicating with you on that. Then finally, I just want to make it very clear that one part of filing is the filing where the trust actually submit its return. But a second part is the return that needs to be filed by those that receive benefits from a trust. In other words, the beneficiaries. And be aware of the fact that it's not only beneficiary. There might be attributable income that is attributable in terms of Section 7 or paragraph 68 to 72 of the 8th schedule. Those people also need to ensure that where they have received a benefit from the trust, they need to submit it. Now, we have done some statistical analysis, and we have found a significant number of beneficiaries not having submitted their returns. So please be aware of the fact, if you do not submit your return, or at least submit that portion of income in your return from this trust, you may be penalized to the full extent of what SARS is allowed, because the expenditure is reflected in the trust, and you are expected to show the income on the side of the beneficiary. Thank you very much. Ladies and gentlemen, I then hand over to my colleague Jan Coetzee, who will take you through some of the other concepts. Thanks, Jan.
Yes, good evening, everybody. As Michael said, Jan Coetzee is the name. We heard our colleagues Nosipu and Nozuku discussing the first pillar of tax compliance, being the requirement to register for tax purposes. Michael just explained to us what the second pillar of tax compliance relates to, and that is filing. I'll be looking at the third pillar of compliance, namely declaration. So the trust is now registered for tax. It has now filed, or it's under an obligation to file. So what now? But before I get there, ladies and gentlemen, I want to iterate that the office of trustee should not be taken up lightly. It's an office of importance, and trustees cannot abdicate their authorities, responsibilities, or other requirements as laid down by the Trust Property Control Act, augmented by our common law relating to trusts, and also in recent years what our courts had to say regarding trustees. So but before I get there, let's have a look what the Trust Property Control Act has to say. And I thought it good to focus on Section 9 of the Act. Now, Section 9 requires all trustees to act with care, diligence, and skill in managing trust affairs. Now, please give trust affairs a wide definition and don't just hone in on the trust's assets and liabilities, if you will. What about other pieces of legislation applicable to trusts? In our world, we look at the trust, the Income Tax Act, and also the Tax Administration Act. So it is important to understand that a trustee has got various responsibilities dealing with trust affairs. As I said, give it a wide definition. Section 9(2) of the Trust Property Control Act says that trustees cannot contract themselves out in terms of the trust deed of any liability. And as Nosipu said earlier in her presentation, that a trust is actually a contract whereby one person, the donor, founder, settler, enters into an agreement with the trustees to benefit a class of people also known as the beneficiaries. And in terms of this document, the trustees are obliged to adhere to the terms and conditions thereof, from the very first clause up until the last clause. And if the trustees don't act accordance with the trust deed, well, at the end of the day, they are in breach of their obligations. Now, ladies and gentlemen, there's one very important doctrine in the South African trust law, and that relates to the joint action rule. Now, in essence, the joint action rule requires all trustees, emphasis on all trustees, to apply their minds collectively and decide what to do. Now, a trust is a creature of decisions. For the trustees to enter into any transaction of any sort, whether it's the vesting of assets, the vesting of income, the vesting of gains, entering into an agreement with a third party, whatever the case may be, due resolution must be had and taken by the trustees. And in the Simplex versus Van der Merwe court case, the court clearly stated that if trustees are not duly authorized to act as such, any decisions taken by them will be null and void. And here's the kicker, ladies and gentlemen. The court went further on to say that you cannot ratify decisions. Hence the reason you cannot put the proverbial cart before the horse. The trustees must act jointly when deciding on a certain course of action. Now, my colleagues have referred to the Tax Administration Act insofar as it relates to a representative taxpayer. And as you can see on the screen there, I'm not going to divulge too much on it. Trustees are representative taxpayers, and as such, they will be held responsible if they fail to comply with tax compliance. So if we move on swiftly to our next slide. So now we've got our ITR 12T, or better known as the tax return for a trust. What needs to be disclosed in this document? Well, at the end of the day, ladies and gentlemen, it's got to be an open, voluntary, full disclosure of the trust's affairs during the year of assessment, which may include income and expenses, any distributions to the beneficiaries. Michael alluded to it earlier in his presentation with regards to going forward to enable SARS to pre-populate beneficiary tax returns by the information submitted in terms of the IT3T data submission process. Now, SARS is aware of distributions, or should I rather say vestings, and not necessarily distributions. Vestings that have occurred, but unfortunately, the beneficiaries did not disclose such vestings in their tax returns for tax purposes. And why is this important? Because in terms of the conduit pipe principle or the flow-through principle as laid down in various court cases, Rosen and Armstrong, and now entrenched in the Income Tax Act by virtue of the provisions of Section 25 Cap B, the beneficiary will pay the tax. So where trusts or trustees vest amounts in beneficiaries, it must be disclosed on the trust's tax return. We receive many questions, ladies and gentlemen, with regards to, well, beneficial ownership on the one side, and on the other side, the IT3T, for instance. What needs to be declared, disclosed, when there are multiple beneficiaries? So where the beneficiaries are not identified by name, Joe Soap, John Doe, whatever the case may be, but as a class of beneficiaries, for instance, Joe Soap's descendants. Well, from a beneficial ownership point of view, only when the trustees exercise their discretion and choose a person within the class of beneficiaries, that individual, the recipient, the vested beneficiary, if you will, the details of that individual must be disclosed. And this will also typically apply to your public benefit organization type trusts, where the beneficiaries are members of a larger community. Okay, ladies and gentlemen, the important one that I would like to spend some time on, and this will also move into the next slide. What's the difference between a passive trust and a dormant trust? So what constitutes a null return? So now trustees may subjectively decide to treat a trust as dormant because there is no fundamental economic activities. So the trust is not involved in some sort of a scheme in profit making. It just lies there, so to speak. Also known as a bottom drawer trust or a freezer trust. You know, it's kept in the freezer and pulled out of the freezer or the bottom drawer only when the trust is going to be used. So if one looks at what needs to be disclosed in terms on the declaration front, is a null return, ladies and gentlemen, will only consist of a null return if there is no income or no expenses occurred. No income or expenses occurred. No capital gains or losses. Now, to have a capital gain, surely there must be a capital asset of sort. Obviously, no distributions to beneficiaries. I referred to it in my previous slide. Ladies and gentlemen, no assets and no liabilities. Now, this is the one. And I'm going to discuss dormant versus passive trusts as well. And this is a very important concept to understand. And I can't reiterate it enough. SARS is acutely aware. And there's also a comment in the chat about 50% trusts not on register. SARS is acutely aware of trusts not on register that are the rightful owners of some sort of an asset. And let's call these assets lifestyle assets. So the trust would typically own a vacant piece of land with the intention to develop in future years, or the trust may be the proud owner of a Bantry Bay flat or a game farm somewhere in Limpopo. So we can carry on. Numerous examples. The trust may also be the rightful owner of a exotic car, for instance. But the question that begs to be answered is, where did the trust get the money to acquire these assets? Now, in essence, there are four sources of capital, if you will. Two of them relate to loans. The third one relates to donations. And the last one, well, you may have an aunt or an uncle that made a bequest to your family trust. Now, the donation route is rarely used, as you rightfully know, due to the adverse consequences of donations tax. The loan route to a financial institution is also rarely used due to the requirement for the bank to get the mortgage bonds repaid. So affordability becomes an issue. So the last one, and this is the one commonly used by all planners, is whereby an individual makes an interest-free loan to the trust. Now, I'm not going to stand still too much on Section 7 Cap C. It's not the purpose of the presentation, but bear in mind that that loan is a liability. So back to a null return. Can you remember when I said that a null return is a null return when it has no assets and has no liabilities? Now the trust has got this lifestyle asset, whatever asset it may be, of whatever asset class. But unfortunately, there's a liability. The trust is indebted towards the funder for the amounts on loan. So now can you see where I'm going with my story? A dormant trust cannot necessarily be a dormant trust. Now, what about the original donation made by the donor or settler to the trustees, which constituted the original corpus of the trust? From 100 Rand or 5,000 Rand up to 100,000 Rand if you want to use the maximum amount eligible for a donations tax-free donation. Now, I want to refer you to Section 10 of the Trust Property Control Act. And in essence, Section 10 of the Trust Property Control Act requires trustees to open separate bank accounts, maintain these separate bank accounts every time or once a trustee in his or her capacity as such receives money. Now, ladies and gentlemen, the original donation of 100 Rand is money, and it should be deposited into a bank account. Now, remember back to what Nosipu said in her presentation when she referred to this to Section A of the definition of a trust. It's where one person disposes of property to another person, the trustee, to keep in trust for the benefit of the beneficiary. I refer you also to Section 9 of the Trust Property Control Act, where it says trustees are required to manage trust affairs with the relevant skill, care, and diligence, as what would be expected in managing the affairs of another party. And you don't manage a trust for your own benefit, although you may have a beneficiary hat as well. So, in addition, we also receive many queries, and I see there's one query, I think, in the chat, in the question and answer session that says, you know, we've got this trust, but we've never drafted any financial statements. Now, ladies and gentlemen, I would like to refer you back to what a trust deed is. Remember, it's an agreement to benefit third parties. So it's a contract. The law of contract applies to this thing known as a trust construct. So if the trustees look diligently at the trust deed, they will see that one of the clauses in the trust deed requires the trustees to maintain proper financial records. We've also got a court case, BOE versus Doyle, or Doyle versus BOE, should I rather say, where the court clearly indicated that proper financial and record keeping should be done. So, on a yearly basis, whether the trust has got this 100 Rand or not, the trustees are obliged to prepare financial statements. And I would like to remind you also that when this trust was registered at the Master of the High Court, one of the many documents that the Master of the High Court requires is an undertaking by a bookkeeper. And that bookkeeper undertakes certain obligations. So, Mr. Bookkeeper, Mrs. Bookkeeper, you are under an obligation to make sure that the trust's financials are maintained. You put up your name and you signed that you will notify the Master of certain things. So back to a dormant trust. So as one can see, that a trust can technically be never dormant because it's got to maintain a bank account, that 100 Rand. Or how would the trustees show that this 100 Rand donated by the donor forms part of the trust assets and not your assets by virtue of the Latin maxim commixtio, where your assets and the trust assets now mix and become one. Trustees are also obliged under the Trust Property Control Act to ensure that trust assets are kept separately from their assets. So, ladies and gentlemen, I can't iterate enough the importance of the office of trustee. It's not a joke. It is a serious office and it should be taken seriously and not lightly. Trustees cannot abdicate their responsibilities. They may delegate the responsibilities, but at the end of the day, the trustees will be held liable for their actions. And unfortunately, you can't hide from these actions. So back to a nil trust return. Is a nil trust really a nil trust? Okay, what about the vacant land, or should I rather say the Bantry Bay flat? Who pays for the rates and taxes? Who pays for the maintenance? Who pays for the upkeep? Who pays for garden services? Can you see where I'm going with my story? Expenses are incurred. It's funded by somebody else. Back to our Section 7C. SARS is also acutely aware that there are trusts out there where loans are in place and the declaration requirement in terms of donations tax, the IT 144, is not submitted. So I mentioned rates and taxes. What about security costs? There are also trusts, ladies and gentlemen, that we are aware of that are basically just the holders or a holder of shares in an underlying company, and where dividends are declared. And these dividends are directly paid into the beneficiary's pocket, not going into a bank account that's supposed to be maintained by the trustees, because the dividend does not belong to the beneficiaries. Up until such time that the trustees exercise their discretion, will the dividends not belong to them. Not belong to them. So, proper record keeping. And if you found wanting, well, SARS will come with the full might available to it to ensure total trust compliance. So, what needs to be recorded? Remember, I said in my previous slide that open and honest declaration of the trust's affairs during the year of assessment must be done. So, SARS will compare its data. Now, as you'll appreciate, ladies and gentlemen, SARS has got a mine dump of data that it receives from its internal sources, for instance, where trusts are registered for VAT, and VAT submissions are made, or where trusts are registered for pay as you earn as an employer. Well, the information there. Your third-party data, the data received via your IT3Ts, your IT3Bs, and so on. And if SARS discovers that the declaration made on the tax return is not honest, or there's some sort of discrepancy, well, SARS will issue or will assess on a revised basis. So I hope that makes it clear that trusts are not dormant, ladies and gentlemen. There isn't such a thing as a dormant trust. If you as trustee don't want to look after the initial corpus of the trust, well, you'll have to resign and get somebody else to take over your responsibilities. Or even alternatively, deregister the trust at the Master of the High Court and deregister the trust at SARS if on register. That will also alleviate the requirements for beneficial ownership, as Michael referred to earlier. And I would like to end with the following two issues on that page, of page 17. Is, ladies and gentlemen, there's a thin line between tax avoidance and tax evasion. Now, yes, there's authority to the effect that taxpayers are allowed to structure their affairs to pay the least amount of tax within the ambits of the law. But then there are trustees and tax practitioners that push the envelope, if you will, with the provisions of the general anti-avoidance rules are tested to the maximum. So we would just like to gently remind taxpayers to err on the side of caution when it comes to avoidance and evasion. And then last on that slide, very important, the world has become a global village. Everybody knows of everybody's affairs, especially in the fiscal and monetary worlds. So it's of critical importance that you disclose what you need to disclose on your tax return, because in terms of the common reporting standards, the CRS rules, jurisdictions voluntarily, those jurisdictions who have signed up, may I add, share on a voluntary basis information. We look at the Panama Papers, we look at other leakages, and yes, SARS looks at those documents as a source of information. Right. So what happens now, ladies and gentlemen? We've seen from Nzuku and Nosipu and Michael that trusts must be registered for tax, and trusts must file irrespective of whether the trust is passive. So now you may find yourself in a very predictable manner, in the sense that you do not comply. Well, there is something that a trustee can use, and that's to make use of the voluntary disclosure program, also known as the VDP program. Now, the purpose of the VDP program is to enhance voluntary compliance in the interest of enhanced tax compliance, and to maintain the tax ecosystem's integrity. Good management of the tax system, as I said, the integrity of the system, and also to make best use of SARS's resources. The aim of the VDP is to encourage taxpayers to come forward, as I said, on a voluntary basis to regularize their tax affairs with SARS and avoid the imposition of any understatement penalties and administrative penalties. So it's a kind of get out of jail for free scenario. Now, who can apply for a VDP? Well, any person. Now, at common law, ladies and gentlemen, a trust has got no personality. It's got no legal personality. It's not bestowed with any personality. However, a trust for tax purposes is given personality by virtue of the definition of person contained in Section 1 of the Trust Property Control Act. So a trust as a person can apply for VDP relief. Now, the important thing, ladies and gentlemen, to understand from a VDP point of view is that it applies to all taxes administered by SARS, however, excluding duties and levies charged in terms of the Customs and Excises Act. So in addition to the Custom and Excises Act being excluded, where the trust as applicant applies for VDP but has been given notice of the commencement of an audit or a criminal investigation against it, well, unfortunately, the trust won't be able to apply. Some of the requirements, just to mention a couple, as I said, it must be voluntary. It must not involve a default which has not occurred within 5 years of the disclosure of a similar default. It must be full, complete in all material aspects. Come clean completely. And importantly, ladies and gentlemen, it must not result in any refund by SARS to the trust. And last but not least, it must be made in the prescribed form and manner. For further information, I would like you to have a look at our website, SARS's website. I'm sure you're all familiar with the website. Search for VDP external guide, and it will take you through the process that needs to be followed. Ladies and gentlemen, before I hand you over to my colleague Nonhlanhla Khumalo, where she will take you through the fourth and final pillar of compliance, I just want to highlight two issues in the modernization process for trusts from the end-to-end product. Now, Sam alluded to it earlier in her introductory comments that the trust division within SARS has embarked on a modernization process or project, and there are different deliverable dates, and some of the deliverables relate to disputes. And I'm sure you all know by now that as from the 20th of April of this year, disputes can now be submitted via e-filing and not the old way where it used to be done through a manual process. But I would like to mention that should a dispute still be pending, and it was submitted prior to 20 April, well, unfortunately, the old process still needs to be followed. Another modernization implementation that occurred from the 16th of September also this year is the so-called automated assessment in terms of Section 95(1)(c) of the Tax Administration Act. Well, in terms of 95(1)(c), where the trust has been issued with notice to submit supporting risk documents, and the trust fails to submit the documents within the prescribed time, an automated assessment will be issued. Ladies and gentlemen, I trust you found this portion very important. I think the takeaway for you is there is not such a thing as a dormant trust. Financial statements must be drafted, whether the trust is not economically active. Assets must be reflected on the financials. Beneficial ownership must be registered and submitted. And as I said, if you don't want to comply, well, rather get rid of the trust. Deregister it, bury it, but don't keep it in the bottom drawer. I would like to hand you over to Nonhlanhla, who will take you through the next session. Thank you very much.
Thank you, Jan, for your valuable insight with trust declaration compliance. Greetings, everyone. I'll be taking you through the trust payment compliance. It all starts with a notice of assessment. After you've submitted your return or following verification or audit, SARS will issue a notice of assessment, which you would receive notification of via an SMS or an email. This notice, which is available for download and printing on e-filing, it outlines your payment due dates and grace period. It's important for you to adhere to these timelines, as late payments would result in penalties and interest charges. If you are unable to settle the amount in one payment, you may request and enter into an installment payment arrangement with SARS. A payment arrangement can be requested through either e-filing or contact our SARS Contact Centre. On the other side, if you find yourself disagreeing with the assessment, you have the right to dispute it. With the recent modernization of the trust dispute process, as highlighted by my colleague Jan, all disputes can now be submitted through e-filing. You have 30 days after assessment to submit your dispute with the relevant supporting documentation. Again, as Jan has highlighted, it's important to note that if you submitted a dispute before 20 April 2024, you must continue through the manual process. And during the dispute process, you may be able to request a suspension of payment while awaiting the outcome of your dispute case. However, please understand that this suspension is merely temporary relief, and it doesn't guarantee a favorable dispute outcome. The suspension of payment remains a manual process with two options. So you can be able to either upload the formal request letter along with the supporting documentation when you're lodging your disputes on e-filing, or alternatively, you can submit a formal request letter at a SARS branch. In closing, I would ask you and beg you to stay proactive with your trust compliance by keeping with the deadlines and procedures in mind. I'll now hand back to my colleague Jan to address the resident to non-resident distributions. Thank you so much.
Thank you, Nonhlanhla. Yeah, ladies and gentlemen, we thought it good to add some flavor to today's presentation. and we receive numerous queries regarding the distribution of trusts, non-resident trusts, distributing the vested benefits to non-resident beneficiaries. Now, these non-resident beneficiaries can either be resident trusts or, non-resident trusts or non-resident individuals. But before I get there, let me just set the scene, if you will, for the reason for this. Now, in terms of our exchange control regulations, to be exact, Regulation 10(1)(c), that was issued in terms of the Currency and Exchanges Act of 1933. Now, the regulations were issued in 1961. Now, in terms of 10(1)(c), And this is important to understand, ladies and gentlemen. This is the invisible perimeter, if you will, the overarching piece of legislation that prohibits South African residents, now residents, corporate as well as natural, from exporting capital from South Africa directly or indirectly without Treasury's prior approval. So that's 10(1)(c). And as I said, that's the invisible perimeter that protects RSA Inc.'s capital. Now, over the years, exchange control has been relaxed. And I would like to take you back to the 1st of July 1997, when the then Minister of Finance, Minister Trevor Manuel, announced that as from that date, South African residents older than 18 who are in good standing with the South African Revenue Services may apply for approval for the investment of up to 200,000 Rand once off. Now the 200 became 400, 500, 750, a million, 2 million. 2 million became 4 million, 4 million became 4 million per annum, and it's currently pegged at 10 million per annum. That's in terms of section B2B of the Exchange Control and Currency Manual for authorized dealers, which is obtainable from the Reserve Bank's website. B2B refers to your 10 millions. B23, ladies and gentlemen, refers to corporates, companies, whether incorporated or not, or listed in the, beg your pardon, listed in the on the stock exchange or not. It specifically excludes trusts. It specifically excludes company, close corporations and partnerships. So only South African individuals, you and I, and companies may invest offshore. So what this now means is that technically a trust cannot obtain direct offshore exposure by utilizing the 10 million Rand allowance route. But trust can still get offshore asset exposure by virtue of the so-called asset swap. But that's a topic for another day. I would like to focus on what recently transpired during August last year. So with further relaxation in these rules, SARS and SARB now allows, on application, for a manual tax clearance certificate or letter for a resident trust to distribute vested benefits to non-resident beneficiary trusts. Of paramount importance, ladies and gentlemen, the non-resident trust must be a beneficiary as per beneficiary definition of the RSA or resident trust. And the distribution will only be considered if the trust complies with all requirements. And give it a wide definition here. SARS will also look at connected parties, the beneficiaries, are they tax compliant? So it's a strict analysis, it's a strict verification process that will be followed. And if SARS discovers or ascertains through the documents submitted that this could be a structure, a disguised export of capital, thereby circumventing the said regulation 10(1)(c), well, the application will not be allowed. I would like to add that I'm aware of numerous applications that did not meet the test of time and was disallowed for various reasons. The application, ladies and gentlemen, submitted to the email address on your screen there must be supported by documentary evidence that will allow SARS to make an informed decision to enable it to issue the manual letter of compliance. The next slide deals with the South African Trust distributing vested benefits to its beneficiaries, in this case, who are natural persons. Now, these natural persons aren't necessarily on record with SARS. It may have that a child immigrated with his parents or her parents to a foreign jurisdiction whilst being a minor or a couple of months old, or even the child being born abroad to parents that immigrated from South Africa, or even the child after matric or varsity decided to go offshore, found love and married abroad and never came back to South Africa. But back home, somebody established a trust for that beneficiary, whether it was a grandparent or even the parents that decided to diversify their portfolio and retain some assets in trust in South Africa. Be that as it may, at the end of the day, the trustees have vested certain benefits in the beneficiaries, and now they want to get the assets out there. Now, for tax purposes, these non-resident beneficiaries are regarded as bona fide non-resident. They don't meet the requirements as laid down in terms of the definition of a resident contained in Section 1 of the Income Tax Act. South Africa is not the primary residence. It's not their habitual abode. They've got no intention to return to South Africa. So there's no requirement for these individuals to be placed on record to get a SARS number or a tax number. A similar process is as the trust distribution must be followed, whereby an application must be submitted to SARS. Once again, the same email address there on your screen, for a letter of compliance to be issued. The non-resident trust must be a beneficiary of the trust. Now, hang on. I'm looking at the wrong slide here, Nonchalant. We need to move on to the next slide, if you kindly will. So a manual letter of compliance will have to be issued to the trust applying for the transfer of the vested benefit. But now here's the thing, ladies and gentlemen, the non-resident must send to that email address on the previous screen, must send a letter, a request for approval to remit the funds together with the trust, and indicate to SARS, once again, to enable SARS to make an informed decision to ascertain the beneficiary's true residential status. And documents typically that could be submitted would be any form of documentary proof to show objectively that the resident is not, the non-resident is a non-resident. And this could be a copy of the foreign jurisdiction's passport, for instance. Resident certificate, if it's a permanent resident certificate kind of thing. If the child is enrolled at some school, in the local community, any activities that the parents or the child participates at the local community, church services, that kind of thing. To submit as much information to SARS, as I said, to allow SARS to make an informed decision. And then last but not least, copies of certain documents must be submitted, copy of the trust deed, letters of authority, annual financial statements, and the like. Ladies and gentlemen, that concludes the trust compliance section. And it gives me great pleasure to hand you back to our program director, Menae Hendricks, for some remarks to be made. Menae, over to you. Thank you.
Wow, thank you so much to our panelists. Thank you, Jan, and to everyone. I'm sure that you'll bear with me if I want to borrow from our theme this evening. Our trustees of this evening, the Trust Product team, you have indeed disposed of your duties with care, diligence, and skill. And I'm sure everyone will agree with me that this is indeed an impressive panel of experts. You've added a lot of flavor this evening, as you promised, and you unpacked some complex matters and provided informative presentations covering all three pillars of SARS's voluntary compliance strategy. Certainly, you've covered very topical and interesting areas: beneficial ownership, passive trusts, IT3D, and you were breaking down very complex legislative requirements in a manner that will most certainly provide our audience with clarity and certainty. So, ladies and gentlemen, you have reached the final session for today, and we are going to go into a question and answer session. We have noted quite a few of your questions that you have posted already, and some of them have been responded to individually. And I am now going to call on an expert panel to take a few questions. We do have some time. So may I please ask the following experts to join me? If you can just switch on your cameras, please. Jan, Nozipo, Michael, and Nazuko. Thank you so much. I think the first question, Jan, is going to be posed to you. And the question is, I'm a trustee of our family trust that was formed by my father. I've heard the term distribution and the term vesting being used. Can you please explain the difference between these terms, Jan?
Yeah, Monet, very good question, I must add, because we find these kind of questions coming through to us, not via this program, but, you know, on email and telephonically and in informal discussions with colleagues and friends. And unfortunately, Monet, if I can use the word unfortunately, the term has been and is still being used interchangeably. For a distribution to happen, there must be a vesting. So, to put it differently, vesting is a fundamental prerequisite for distribution to follow. So, I'll give you an example. The trustees may decide in year one to vest 100,000 Rand in a particular beneficiary. But distribution thereof only occurs 5 years later. So that's the difference between a distribution and a vesting. As soon as vesting occurs, the beneficiary acquires a personal right against the trustees for delivery of the vested benefit, whether it's transport, if it's fixed property, whether it's payment, if it's in our example, 100,000 Rand. And as I said, unfortunately, the term has been used interchangeably, but the correct manner to approach it is that vesting occurred followed by distribution. Now, for tax purposes, it's very important to understand the two, because if you look at the Income Tax Act, it says the receipt or accrual of. So it's the earlier of the two when the taxing obligation arises. So back to my example of 100,000 Rand when the trustees vested it. So vesting the 100,000 Rand would be equivalent to accrual. And the beneficiary will have to disclose it in the year of accrual, in our case, year one. Distribution 5 years down the line is the receipt portion. So now we see that the vesting of the benefit of the 100,000 Rand happened before the distribution. I hope I answered the question there, Monet. If not, you know, I can elaborate a bit more.
No, thank you, Jan. That is certainly very useful. And I think this question comes up in different formations in our questions this evening. Now,
maybe if I can add to that.
Please go ahead,
Jan,
Mike.
thanks so much, Jan. Yeah, and what most commonly happen would be that those two events happen simultaneously.
Yes,
so,
yes.
you know, there would be a payment of an amount, which would also be the vesting of that amount. So just for those that find, you know, that no clear distinction between the two events that Jan mentioned.
Yeah, Monet, if I can add to it to give it some color, you know.
Go ahead. We are all here for the flavor.
The two terms that come to the fore here is dies wynit and dies cadet. Now, dies cadet would be the day has come, so the vesting has occurred. Whereas dies wynit, the day in which enjoyment has come, is the day when receipt or distribution occurred. And as Michael rightly said, these two days, these two periods can differ, but it can also be simultaneously.
Okay, gentlemen, thank you for that. Now, I just can't resist. You did invite me to be your program director. So I think the next question, Michael, I'm going to pose to you, and it relates to a public benefit organization. And I would like to ask you, if I represent a PBO trust, we are required to provide beneficial ownership information. There are no specifically named beneficiaries in the trust deed. How do I report this in the tax return?
Sure. Very interesting question. and one that we've had during the year from quite a few stakeholders. So in answering that, Monet, I'm going to hand it back to you. No, I'm just lying. that is Monet's area of expertise. But nonetheless, so from a trust perspective, to report on this type of thing, there's a few factors that you would consider. Just talking off the top of my head. The trust instrument would be of critical importance. So you would need to consider, what the trust instrument indicates, in terms of that, what is required of you for the NPO status. So in other words, if they supply books to, or they supply food, then, it might be that the income or the expenditure that relates to this is in actual fact just expenditure within the trust. So you won't specifically have any beneficiaries that are determinable from the trust instrument. I mean, it is practically impossible to indicate the 500,000 people that received money from or received food from the trust, and how do you quantify it? So, from a practical perspective, that's just not the way to go. So in that case, it would be reflected as expenditure in the trust. Then you won't be able to indicate beneficial owners from the situation. However, it could be a different scenario where there's amounts that are actually determinable to have gone to specific individuals, and then that will be indicated in the income tax return in the container on beneficial ownership. Bearing in mind that the moment that unnamed beneficiaries, when they are actually named, they now become named beneficiaries. So if, for instance, you have a situation where there's a category, but the individuals receive, let's say, a donation or an amount to further their studies, whatever the case may be, then those would now be determinable, and you will have to indicate that in your return. The one other thing that we need to talk about is, what about unnamed beneficiaries? Originally, SARS decided to require of trusts to indicate all beneficiaries, including unnamed beneficiaries or beneficial owners for that matter. However, when looking at the primary legislation, being the Trust Property Control Act, it indicated that unnamed beneficiaries are not required to be submitted, the detail thereon. And SARS took a step backwards and said, wait, we will also comply with what the primary collector of beneficial ownership information requires, and we will not require the details of beneficial owners in the sense of unnamed beneficial owners. So for this year of assessment, in the 2024 year of assessment, if you would have a category of beneficial owners, beneficiaries that are unnamed, you will click the button Other. Further detail can be provided or are provided in the comprehensive tax guide. But as I indicated, for the future year, for next year, we will be making provision in our tax return for more details on unnamed beneficiaries. But for this year, we have the workaround. Thanks, Michael.
Thank you so much, Michael. That's very useful, because in our question and answers, there have been questions relating to the unnamed beneficiary as well. So thanks for covering that as well. Now, ladies, I'm going to turn my attention to you and Nosipho. I would like to ask you, the income tax return makes provision for 20 beneficiaries in its BO container. That's beneficial ownership container. However, the distribution schedule requires 50 names of beneficiaries to be populated. The different requirements are a little bit confusing. So can you clarify for us, how do I submit this information?
Thank you very much, Monet, for that question. So the income tax information required for trusts and the beneficial ownership information required in the income tax return should not be confused, right? So the current income tax return for trust requires that where distributions are made to beneficiaries, the top 50 distributions should be reflected in the distribution schedule that forms part of the income tax return for trust. So this information is in essence a summary of the amounts that are vested to the beneficiaries. Then the requirement to provide beneficial ownership information is a separate requirement. And currently the return provides for 20 beneficial owners to be populated per category of the beneficial owners. So in this case, 20 beneficiaries. However, please note that a schedule of all beneficial owners should be attached to the income tax return on submission of the return. So by way of an example, the difference can be explained as follows. So let's say a trust with 100 beneficiaries submits its annual tax return. So if it vested amounts to all the 100 beneficiaries, the top 49 highest value vestings should be populated by beneficiary name, with the aggregate of the remaining 51 being populated in the 50th container. So this means that the total should balance with the total amounts vested. So then using the same listing, the names of the top 20 amounts that were vested should be populated under the beneficiary container under the beneficial owner section of the return. And then the sheet containing the 100 names and other details should then be attached together with the other beneficial ownership details when submitting the return. I hope that answers the question.
It does. Thank you so much, Nosipo. Now, my next question I'm going to pose to you, Nozuko. We have seen so many comments tonight and questions and answers about I'm unable to submit my IT3T data. I'm unable to transact because I have not kept my beneficiaries up to date. You have highlighted in the presentation the importance of keeping registered representatives up to date. So can I ask you, Nozuko, can I change the registered representative of the trust on the SOX platform?
Thank you, Mine, for that question. Yes, a registered representative can be changed or updated via the SARS online query system. A SARS query type to select for this, it is called a request to be updated as a registered representative. You also have to upload all the required documentation when you do this. I also want to mention that you can update this, the registered representative on e-filing as well as the branch. First, you have to book an online appointment. Thanks, Mine.
All right, thank you for that. So yes, we have to keep those registered representatives up to date. And as you also reminded us, it's our requirement within 21 business days to do so. My next question, I think, Jan, is for you. And again, no harm, yeah, but it is my area of expertise. So I'm a trustee in a PBO trust that provides food to victims of natural disasters. So how do I know at what stage I need to submit an IT3T form to SARS?
Yeah, Mine, you're right. I'm sure you know what the answer is. So the question boils down to a trust with a benevolent intent to benefit, certain members of a community, and how to submit the IT3T information. Now, I think, Michael, you kind of answered a portion of the question already in your presentation, or in your answer to your specific question. But Mine, I think the important thing here is to first look at the terms and conditions of the trust deed, because there's various scenarios that one, have to look at or explore. So if the trust, as I said, with the benevolent intent to benefit a certain community, and once determined what the object of the trust is, obviously the financial statements will then be drafted accordingly. So let's assume a trust is created to assist with disaster relief. Assuming like recent floods, for instance, and now the trust comes to the fore and say, okay, we would like to issue blankets, we would like to issue food parcels, or what the case may be. So the trust has benefited victims of disaster. Now, to Michael's point, if the trust's financial statements reflect expenditure, operational expenditure, well, then technically there wasn't any vesting, because the trust assisted by purchasing or giving funds. So in those instances, there's no information that needs to be uploaded because there's no single beneficiary that benefited. It was a lot of individuals. Now compare this one, for instance, Monet, with the trust that was created with the intent of enhancing literacy or educational purposes. And now the trustees decide, after a due process, to benefit 100,000 Rand each in 5 beneficiaries, to enable these beneficiaries to further their tertiary studies at a university of their choice. Now, there one can see that the potential beneficiaries are lots of students out there, but only 10, made the cut, if you will. And the details of those 10 beneficiaries will then have to be submitted via your IT3 mechanism. And Monet, I know it's not part of the question, but it also holds true to beneficial ownership. Yeah. So, but I know I answered your question.
No, you did certainly, and we have been getting quite a lot of questions on this, so thank you for bearing for me. I'm keeping an eye on just the time that we have left, so I'm going to go into our final question for this evening. And Nosipho, I would like to ask you our last question this evening. I am a parent of a special needs child. How do I go about registering a special trust with SARS? And what would be the benefits of doing so?
Yeah, thank you, Monet, again for the question. So firstly, the trust must be registered with the Master of the High Court as either as an inter vivos trust or a testamentary trust. Thereafter, you may apply to register the trust as a special aid trust via the SARS online query system with all the required supporting documents. So as Nuzuga indicated during her presentation, the detailed list of all the required supporting documents is available on the SARS website. So when it comes to the tax benefits of registering a special trust type A, is that they are taxed on a sliding scale as natural persons rather than at a flat rate of 45%. Additionally, they do benefit from a lower effective capital gains tax rate. So they are therefore taxed on 40% of the capital gain at the beneficiary's marginal tax rate compared to the 80% inclusion rate for ordinary trusts. And then a special trust type A also qualifies for the annual CGT exclusion, which is 40,000 Rand for the 2024 tax year. And then lastly, on the sale of a primary residence, they do also qualify for the 2 million Rand capital gains exemptions on that property. Thank you.
All right. Thank you so much. Panel, thank you for disposing and for bearing with my questions this evening. You have done very well, and also thank you for answering some of the questions that have been posed to you in the chat box. Ladies and gentlemen, if your question has not been answered, please look out for the FAQs on the SARS website, where they will try to respond to as many questions as is possible. If I may also just add, this team is very dedicated to making things easier, to modernizing and demystifying what has been a very niche type of tax product. As people have mentioned this evening, we are looking at modernizing with the Master of the High Court, with other regulators. So as someone who works with this team, I do want to just say, look out, there's some very exciting developments coming, and I can tell you this is a very passionate and dedicated team who is trying to assist their taxpayers as best as they can. If I can also just give advice, there has been a lot of questions this evening on the IT3T submission of data. And if you do send a query, can I please ask you to make sure that you send a copy of the error message that you are receiving? It will make it so much easier when the team does try to assist you with the filing of the IT3T information. So, ladies and gentlemen, we are coming to the end of our webinar, but before we do, I would like to ask Advocate Sam Milligan, the very capable leader who is leading this innovative team, to provide us with some closing remarks for this evening. Sam, if I may ask you to give us some closing remarks, please.
Wow. Yeah, so that was very well done, I think. In closing, I want to thank our program director for a sterling job. Mine, well done. I also want to extend my gratitude to all the participants for attending this webinar and for posting insightful questions. It was delightful to have you here this evening. Please rest assured that all questions not answered during this webinar will be addressed shortly, and all questions and answers will be posted on the SARS website. Thank you to all the speakers and colleagues involved for your valuable contributions in making this webinar possible. To trustees and trust representatives, SARS encourages you to go digital. We have made it easier for you. You can register on the SARS online query system, SOX, and file your IT12T using e-filing. If you require further information on trust, please do not hesitate to reach out to us via WhatsApp at 0800 117 277. You can also go to the SARS website at www.sars.gov.za and click on the Trust webpage. Additionally, trust information can be found on various social media platforms. You can access information using LinkedIn, the South African Revenue Service, Facebook at facebook.com/SARS Tax, Twitter at SARS Tax, and on YouTube at www.youtube.com/SARS Tax. By addressing the areas highlighted by the various speakers and taking proactive steps, we can significantly improve compliance levels for trust. Your cooperation and commitment to maintaining high standards of compliance are essential. Thank you for your attention to trust tax matters. Stay informed, stay compliant. I will hand back to the program director for final words. Back to you, Mine.
Thank you, Sam. You have lit up the screen. I see lots of applause and hearts and thumbs up, and I'm very encouraged by the community of trusts that we saw this evening. Even in the questions and answer sessions, some of you were trying to assist each other. We do understand and appreciate that this is quite a complex area and there's still a lot of modernization, but we are hopeful that it is definitely underway. As we close out this evening, ladies and gentlemen, I would like to thank you all for your time and your participation. I hope this webinar has met all of your expectations, or at least some of them. And before I close, I also just want to thank all of the speakers, the panelists, the organizers, and the IT team who's been behind us this evening for your contributions to this webinar. Please remember the presentations will be posted on the SARS website and the webinar recording can be accessed on the SARS YouTube channel. Please, we request you as you leave the webinar this evening, you will get a pop-up screen that will ask you to take our survey. The team really does look at the feedback that we get from these surveys and we use it to improve and just to further our products for our clients. So please take our online survey. And with that, I'd like to thank you everyone for a very exciting webinar, and Thank you for your time this evening. Goodbye.
Fellow South Africans, I'm addressing you this evening.
All your years of paying tax, you helped us overcome our darkest hour. You, along with every other loyal taxpayer, helped build this nation. Thank you for every life you saved and for every risk you braved, for giving our future generation a healthy start. When you saw many of our vulnerable communities, you provided for them. When you saw our healthcare workers on the front lines battling COVID, you rose to the occasion and gave them the tools to save lives. Without your tax compliance, we wouldn't be able to fight a good fight. Thank you for contributing to the important services our vulnerable communities rely on every day. To all taxpayers and traders, continue to pay your tax because it matters to millions of South Africans who depend on it. Your tax matters.